All right, so in our very last video, or the live that we did on Sunday, we were looking at, we looked at Elite Diagnostic. All right, so we're doing a complete analysis of a company. All right, and we actually diagnosed Elite Diagnostic. All right, and we know exactly where the problem is in the company. All right, so I'll just pick up from where we left off on Sunday. All right, so the issue the company had is, or the issue that the company have, the issue that the company has is its turnover. All right, it's asset turnover, not the total asset turnover, but the fixed asset turnover. And when we talk about fixed asset turnover, sorry, it is referring to the company's ability to use its fixed assets or its asset efficiently. All right, so we like companies that are able, or the company must be able to use its assets efficiently, all right, and make money with those assets while spending as less on those assets as possible. But we're seeing where, and we also talked about the company's inability to expand without spending or buying a lot of those assets, all right? So the scalability of a company is not amazing. So it's not a company that we see scaling up very fast or very efficiently. All right, so that is the issue that we're having with Elite. So let me just share my screen so we can just look at Elite's turnover. All right, so what you're seeing on your screen is Elite turnover. All right, asset turnover. So as you can see, the asset turnover from 2017 to 2021 has been falling off. So that fell from 0.99 in 2017 to 0.73 in 2021. Now, as it relates to the latter year, 2021, 2020, 2021, we know exactly what was happening with the asset at that time, why the company was not using the asset efficiently. All right, so a couple of the assets, such as the assets in Jack's Hall, that specific office, those assets were down throughout 2020 heading up to 2021. So those assets were not being used, or whether they are recorded on the financial as total as a part of total assets. So that accounts for the falling off of the asset turnover. Now, what we did was to separate the assets into two parts: the current asset and the fixed asset turnover. All right, so as you can see, the current asset turnover went from 3.5 to 5.06, all right, over the same period. So the company was using its current asset more efficiently. All right, so that's not the issue. The issue was with the fixed asset turnover, which went from 1.37 to 0.85. All right, so the fixed asset fell off even more drastically than the total asset in terms of its turnover, in terms of how efficient those assets are being used. And we talked about just now what occurred for those falling off in the latter 2 years. However, the fall off has been occurring over the entire period. All right, so it seems that the company has an issue, a fundamental issue as it relates to using up its assets efficiently. Now, in the last 9 months, this is very important because in the last 9-month management state that those assets that were non-operational in the Jackson office came back on stream. All right, so we are expecting that in the last 9 months those assets would be more efficient. I mean, the turnover would start improving. All right, so we see where the turnover improved over the last 9 months from 2021 to 2022. There was an improvement in the fixed asset turnover. So we saw that moving from 0.64 to 0.8. All right, so the fixed asset, which is the issue that we're seeing, the fixed asset turnover, which is really the problematic aspect of the company's operation, we see that improving, whereas the current asset turnover decrease. All right, so that went from the 5.3 that we talked about to now 2.4. All right, so the company is getting more efficient in terms of its fixed asset usage, while it's getting less efficient in terms of its current asset usage. All right, now what I want to do in this video is to value the elite stock. All right, so we will place a value on elite stock in this particular video. All right. All right, so what you're looking at is the actual model that we designed to value elite stock, and we did this in July recently. All right, so let us get into some of the assumptions that went into this model that we used to value the stock, and we'll see what the price came out to be, and then we'll compare that with what the actual price is on the Jamaica Stock Exchange. All right, so as I stated earlier, the company cannot grow without adding more property, plant, and equipment to its operation. All right, so what we want to do is to model the property, plant, and equipment, the PP&E, going forward. Now, over the last 6 years, what we realize is that the company has been growing property, plant, and equipment by an average of 21% per year. All right, so in the last year, we didn't see that growth. That actually fell off, but overall, it was a 21% per year on average growth that we saw in property, plant, and equipment. Again, the company cannot scale up without adding property, plant, and equipment. So we're saying that we're assuming that over the next 5 years, the company will continue to grow at that magnitude, 21% per year. All right, it's property, plant, and equipment. So as a result, we see the property, plant, and equipment growing up to becoming $1.5 million in 2026. All right, 2027. All right, and there's when the stock, the property, plant, and equipment of the company peaked out. All right, so the company grew from 711. Currently, the company has about 500 million in terms of its property, plant, and equipment value. All right, so we're assuming by the end of 2022, that will increase to 700 million, 711 million, and we'll see where it increase up to 2025, 1.2 billion, and up to 2026, it reached 1.5 billion, and then it peaks out there. All right, so we're assuming that the company would have peaked out at that point. All right, and property, plant, and equipment is maintained up to 2030. So the company would simply start maintaining its property, plant, and equipment at that point and not adding more property, plant, and equipment at 2026. All right, so if the company over the last 3 years, over the last 6 years, grew its property, plant, and equipment by 21% per annum, and we'll see where the company has about 3 offices. All right, one in Ligonier, one in New Kingston, and one in Jacksall. Then that growth rate over the next 5 years would see the company having about 3 more offices, all right, across Jamaica. So the company, we're assuming that the company would have about 6 offices in the next, by 2026, all right? All right, so we just looked at the company fixed asset turnover. Now, how efficient is a company using these assets? All right, so we saw where the fixed asset turnover was on 0.85%, 0.85. All right, so we are assuming that the company's turnover is 0.93, and that is what turnover was. Let me see in which year. Here it is, 0.93. That was in 2018. All right, so that's quite efficient far more efficient than the company is really using up its assets. So we're quite optimistic about Elite. We're giving it the benefit of the doubt in our calculation. Now, as a result of the turnover, we're assuming revenues of $662 million by the end of 2022. $802 million by the end of 2023. And you can see where revenue continues to increase up until 2030. All right, where we'll see the company having revenue of $1.5 billion. All right, depreciation is very important, and we assume a 15% depreciation of these assets going forward. All right, so you can see what depreciation of the asset looks like up until 2030. All right, and this the company will have to keep replenishing the assets. So depreciation is very important to our calculation. All right, so these are some of the assumptions that went into our calculation. Again, this is a terminal value. All right, so this is the growth rate at the after 2030. All right, so after 2030, we are assuming that the company will grow some 4%. And if you know anything about blue collar finance valuing company, the terminal growth rate, we normally use a 2.5%, because our belief is that the company cannot grow faster than the economic case in which a company operates, which is a Jamaican economy, which is growing at about less than 2%. All right, so we believe that in the future and going forward, the company cannot grow larger than the economy. So here we are being quite optimistic. Again, we are using the benefit of giving Elite the benefit of the doubt, and we are assuming a 4% terminal growth rate, which is almost twice as much as our belief. All right, so operating margin. Again, we are using operating margin, the highest operating margin that the company has ever witnessed or experienced in its operation, which is 26, and we're using 26 for the first 5 years, 26 for the second 5 years, and then after the terminal rate is 20%. And if we go to the company's profit and loss statement, all right, and here it is, there's where it's operating margin. This was 26% in 2017. Which fell to 17%, 19%, 7% in 2020, and 6% in 2021. So again, you're seeing where we're giving Elite the benefit of the doubt, and we are using the highest numbers to value this company. All right, so we need to keep that in mind when we're looking at the end result of this valuation. So we're using operating profit of 26% to value the company. Tax rate, Elite has been around, has been listed for since 2018. So at least 3 years of its tax holiday or its tax benefit has gone. So the company only has 2 years left in paying half the amount of tax or no tax, all right, the last 2 years, and then half the amount of tax for the second 5 years. So there's no tax for the last 2 years, 12.5% of its operating income, or taxable operating income in the second 5 years, and 25% the company will return to full tax in the years after 10 years. All right, so after 10 years, the company return to its full tax rate. Depreciation, as we talked about that before, is 15% of the property, plant, and equipment. All right. These are the cash flows. All right. So based on the assumptions that we made about the revenue, about the operating profit, about the tax, and all of these things. So here's where the revenues are. We talked about that. Whatever we talked about the revenue, that is what it comes to. 26% tax rate. Now the EBIT, this is what the EBIT would look like for the company. All right, and this is the after tax. All right, so after we calculated tax, this is the after tax EBIT. All right, and as we said, for the first 2 years, the company will pay no tax, because at that point the company will return now to paying 12.5% in taxes and a full 25% in taxes after that tax break is over. Now we assume that a company is reinvesting back into the business, keeping those assets replenish so as to get the optimal operation from those assets. So that is the figure, the depreciation figure that we calculated first. This is what it is. We believe that the company will continue to replenish its asset. All right, so that means putting back what is depreciated, keeping the asset optimal in terms of its operation. So the company will keep reinvesting in the business, and these are very conservative figures. All right, so when it comes on to revenue, we are being quite optimistic. When it comes on to expenses, we are being very conservative. So the figure, whatever price we came out with, the Elite Diagnostic Limited, supposed to be the optimal price. As a result of that, this is a cash flow of the company and the cash flow to the firm. All right, so what that means is that both equity holder and debt holder will partake in this cash flow. All right, so the cash flow to the firm is what we're looking at in this row. All right, so let me just increase the screen. So after 10 years, the cash flow after 10 years, all of the cash flow, again, we are assuming that the companies are going concern. That means the company will continue to operate for life. That's the assumption. So after 10 years, the company will have some money coming in, like year 11, year 12, year 13, year 14, and onward. So all of those money, when we pull back all of those money, all right, to 10 years in the future, it is $3.3 billion. So we're assuming that the company will make some $3.3 billion in the future. All right, so 10 years in the future, the company will make some $3.3 billion. Now, that money in the 10-year future will have to be measured into today's dollar amount. All right, so we also pull that money into today's dollar amount, and that becomes $1.7 billion. All right, so the company is now valued at all of that cash flow after 10 years is worth $1.7 billion today. We have some cash flow that will come from the company leading up to the 10 year. So next year, year one, the other year 2, year 3, going forward up to the 10 year. Those cash flow, we pull back those cash flow and value them into today's dollar amount also, and those are worth some $755 million. All right, so what we did was to add both cash flow together, the $1.7 billion and the $755 million. So the company's worth, the operating asset of the company is now worth $2.4 billion. All right, now the company has some cash. So when we look at the cash balance of the company, pull those cash balance in, we had the cash balance at that amount. The company has some $176 million in cash. We had that because that is value to the company. However, what we're trying to find is the equity value of the company. All right, so the debt that the company has, we are assuming that we will pay off those debts. All right, so what is owed to the debtor? We want to the creditor, we want to pay them back their money. Now the company has some $384 million in debt. All right, so we less that from the company's value, and we are now left with $2.2 billion. All right. However, what we did was to not take the risk of those cash flow into our calculation. All right, so that $2.2 billion never include the risk that these cash flow have. All right, so what we want to do now is to incorporate the risk of those cash flow, and the more risky the cash flows are, the less we are able, or we are willing to pay for those cash. All right, so when we incorporate the risk, the company is now valued at $1.1 billion. All right. Now, The company has some 353 million shares outstanding. To be exact, 353,400,000 shares outstanding as of the last trading day. All right, so when we divide the outstanding shares by the $1.1 billion, the company is valued at $3.1. All right, $3.19 per share. All right, so we're seeing Elite has value in $1.1 billion, and that amounts to $3.19 billion, $3.19 per share. Now, what is Elite value today? All right, so we want to just quickly up over to the Jamaica Stock Exchange site, where we can just look at the company's value, all right, to see what exactly is Elite value today, to get an understanding of whether or not the company is overvalued or undervalued. All right, so the overall value of the company is $1.1 billion. And remember, we're using optimistic figures, all right? So we use all those figures, we lessen the expense, and we push the revenues and the operating profit to the limit, the upper limit, all right? So this, we are really pushing the buck with this Elite stock, all right? And we're assuming that the company will grow in the future for the next 5 years as it grew the last couple of years, All right, so here it is that the stock is valued some $3.06. All right, I mean $3.06, and that gives the company a value of $1.2 billion. All right, so we're getting a value of $3. So the company is selling for higher than our value. And again, we state that the company is selling for higher than what we valued the company for. And we see where our assumptions are on the the optimistic level. All right, so Elite at this time does not seem to be an attractive buy. All right, so like the video, share the content, help me grow the channel. Chat to you at the next one.